Bitcoin's structural weakness is real, but what nobody's talking about is that the Japanese yen just hit a 40-year low, and that tremor could shake markets far harder than another crypto correction. Somewhere between a collapsing currency and a semiconductor bloodbath, the real story isn't the numbers, it's the rotation. Tonight we're going to follow the money where it's actually moving, not where the headlines say it should be. The narrative around Bitcoin's struggle is correct, but it's hiding a far more interesting macro setup, one that's about to get tested harder than the market realizes. Hey, welcome back to Finance Graf. Today, the spot ETF exodus, a reckoning, not a capitulation, the yen's collapse. When currency breaks, everything moves, the chip chaos and the rotation nobody admits, and regulatory relief on the horizon. If politicians can act like adults plus 6 more, let's get into it. Let's talk about what the numbers actually say, because context matters tremendously here. As of late June 2026, Bitcoin spot ETFs had experienced an outflow of roughly $4.1 billion in that single month alone, the largest monthly withdrawal on record. That's over 100,000 Bitcoin that have exited those vehicles since the start of the year, with more than 160,000 Bitcoin sold through ETFs since October 2025. Now, before you interpret that as a doomsday signal, consider this. Bitcoin spot ETFs have never actually lived through a full bear market cycle. They were created near the beginning of a bull run. So naturally, they haven't seen a drawdown quite this severe. Graf's take. It's startling, but it's not historically unprecedented because the historical record simply doesn't exist yet. The real ETF price point sits around $73,000, which means current holders are nursing losses. That's the kind of pain that usually precedes capitulation, but here's the wrinkle. We're not there yet. Long-term holders have accumulated 16.1 million Bitcoin, a record high, but their MVRV ratio has compressed down to 1.24, the lowest in 3 years. That's the inflection point we've historically watched. In previous cycles, the actual bottom arrived when long-term holders finally went underwater. We haven't crossed that threshold, which suggests the correction might have further to run. Now shift your focus away from crypto for a moment, because this is where it gets genuinely interesting. The Japanese yen has crumbled to its weakest level since 1986. We're talking 162 yen to a single dollar. You might think a weak yen is simply bad for Japan, but that's the novice reading. In reality, it's a two-edged sword that's cutting through global markets right now. For Japanese exporters like Toyota, a weaker currency is gift-wrapped profit. Their goods cost less abroad, margins expand, and Tokyo's stock market has been ripping higher as a result. That's the win. The other side, Japan imports oil and gas priced in dollars, which now costs substantially more in yen. Consumers feel this immediately. Electricity, food, gasoline, all creep higher. The Bank of Japan has already tried circuit breaker interventions, deploying over $72 billion in support, but it's barely slowed the descent. Here's where my mustache gets appropriately twisted. This currency deterioration is partly intentional. The carry trade is alive and well, driven by the gap between 0% rates in Tokyo and relatively higher yields in New York. That trade is essentially printing itself, and the yen keeps sagging. What happens when the BOJ finally decides it's had enough? When they jack rates up aggressively or flood the market with circuit breakers that actually hold? Markets could get thrown around like rag dolls. The division markets, equities, bonds, currencies, are all coiled on this trigger. While we've been fixated on Bitcoin under 60,000, semiconductors have been engaged in an absolute arms race. And I don't mean the healthy kind. Let's zoom in to what's happening at ground level. Supermicrocomputer SMCI tanked over 9% after Taiwanese authorities launched chip smuggling investigations. That company was already nursing a 77% collapse from its highs following a bookkeeping scandal in 2024 that nearly got it delisted. SMCI is one of the architectural cornerstones of AI infrastructure. If it's wobbling, the entire house of cards should get nervous. But here's the real story. From April through June, Bitcoin and gold ETFs accumulated about $12 billion in profits, while semiconductor ETFs, the SOXX, the SMH, captured over $20 billion in the same window. That's a rotation, plain and simple. Traders are pulling capital from the hedges and the narrative plays and shoving it into the actual productive assets, driving the AI build-out. Color me skeptical, but this doesn't mean gold and Bitcoin are dead. It means the capital is rotating and rotations reverse. What's happening now feels disturbingly similar to when altcoins pump and retail suddenly remembers they exist and piles back in, chasing a train they think they missed. Semiconductors in May saw gains of around 81% in some vehicles while doubling in others. That's not sustainable. That's heat. And when heat reaches critical temperature, there's usually a sharp correction. There's one antidote that's been brewing in the legislative oven, and if it actually clears the kitchen before Congress takes summer break, it could rewrite how crypto operates in America. The Clarity Act is arguably the most critical piece of market structure legislation for digital assets that the United States has attempted to pass. The essence is simple but profound, clearly separate which regulatory body, the SEC or the CFTC, oversees which token. Right now, projects and investors are operating in a fog. Regulators themselves aren't entirely sure who owns what jurisdiction. Clarity would draw bright lines on DeFi, stablecoins, token classification, and exchange security requirements. The pressure is mounting, though. Senate leaders have imposed a July deadline. After summer recess hits, priorities shift and momentum dies. Senator Loomis has indicated the final text should be published around the 4th of July, but even that's ambitious. If it slips, the bill could sit dormant for months, waiting for the new fiscal year to arrive before getting another shot. This old coin trader has seen regulatory theater before, and I'll grant you, the timing feels precarious. But if clarity passes before recess, it removes an entire category of uncertainty that's been weighing on institutional players. That's not a guarantee of higher prices, of course. It's a removal of downside risk. It's the difference between stepping through a door and walking through a minefield blindfolded. Let's talk mechanics, because price doesn't move in a vacuum. It moves on the back of leverage, and the margin calls that follow. As of late June, Bitcoin sits below that critical $60,000 support, and the technical structure remains demonstrably weak. But if we zoom into the derivative markets, something interesting has been happening. Open interest from Bitcoin's June 2025 highs of around $45 billion has compressed down to roughly $20.4 billion. That's a collapse of better than 50%. Essentially, the leverage has been wrung out. We've seen multiple liquidation cascades, most notably in October 2025, when Bitcoin nosedived from 122,000 to 105,000, and again in early February when we grazed 60,000. Each time, forced selling triggered cascades. That's the terrible mechanics of a leveraged market. The silver lining is that much of that leverage has already been cleaned out. The market is leaner, meaner, and less prone to waterfall liquidations compared to where we were 6 months ago. But, and this is where funding rates and long positioning matter, traders are quietly loading up on long bets again. Funding rates have turned positive, open interest is ticking higher, and the liquidation heat map has returned to green above local highs. That's the classic setup for a sharp wick lower that wipes out the fresh longs and generates fresh bid flow below current levels. If you ask this old coin, that's precisely the kind of tinder that lights fires in bear markets. Not capitulation to new lows, but the false dawn that makes everyone comfortable again, just long enough to get clapped. Last week, just to put a temporary floor under equities and Bitcoin, we saw headlines. The US and Iran agreed to set up new talks. Markets immediately reinterpreted this as rate cut friendly, peace friendly, risk on friendly. Bitcoin popped a quick 2.3% on the relief. Equity markets, already swimming in bubble dynamics, interpreted it as a green light. But here's where I reach for my monocle and take a skeptical squint. Markets aren't in a rational frame of mind right now. We've already seen capital flee from gold and Bitcoin into semiconductors and AI plays. The relief rally felt too convenient, too timed, too much like a pressure valve that gets cranked open just before everyone panics that the valve's stuck. Real geopolitical de-escalation takes weeks or months to play out. One good headline doesn't reset a decade of Middle Eastern volatility. What we saw was a textbook bounce that gave traders an exit from oversold positions, not a fundamental reset. The market sensitivity is extremely high right now, which means the next shock, whether it's real or imagined, could trigger a sharp move in either direction. The problem is that when you're surrounded by extremes, weakest yen in 40 years, semiconductors up 81% in months, Bitcoin under structural pressure, the system doesn't have a lot of cushion left. Here's a detail that doesn't get nearly enough airtime because it doesn't fit the narrative of institutional adoption, but it matters. Major crypto exchanges are quietly shutting down services for users in the European Union. Binance did it. Bybit has announced the same. They're not disappearing entirely. They're migrating users to separate platforms like Binance.eu and Bybit.eu, but the consolidation is real. The regulatory noose in Europe is tightening, and some operators have decided it's simply easier to fragment their user base and comply with EU rules through a separate entity than to keep fighting. Now, if you've been in the space for years and you've got an account on the original platform, you need to check your email. Seriously, some users might receive notices requiring them to migrate or face forced liquidation. Assets won't vanish, but getting left behind in the migration process could lock you out of trading or withdrawals. This isn't some crypto panic narrative, it's boring regulatory machinery working exactly as it's designed. But it does signal something subtle. Europe is no longer viewed as a strategic market by the largest players. They're ceding ground. That doesn't mean crypto is dead there, obviously. It means the regulatory framework has become so hostile that the cost-benefit calculation tips toward retreat and restructuring. This old mustachio has watched jurisdictions squeeze industries before. When the big players start filing paperwork to wall themselves off, it usually means the regulators have already won the negotiation. Pull back far enough and the picture snaps into focus. We have a weakening Bitcoin price that's been under pressure for months, which is accurate. We have spot ETF outflows that are historically large, also accurate. But simultaneously, we have a Japanese yen in free fall, which is generating carry trade fuel and making dollar yields more attractive, pulling capital away from traditional hedges. We have semiconductor valuations that have doubled and tripled in mere months on AI enthusiasm, creating a capital vacuum where Bitcoin used to live. We have regulators in America potentially clearing away uncertainty with clarity, and regulators in Europe actively dismantling the ecosystem by making compliance uneconomical. The mechanism is complicated, but here's the stripped-down version. Capital is hunting for the highest risk-adjusted returns. Right now, that's fabrication equipment and semiconductor infrastructure, not digital assets, trading sideways below a support level. Bitcoin's weakness is real, but it's weakness amid a much larger rotation. That doesn't mean this rotation can't reverse. Rotations always reverse eventually. It means that buying into Bitcoin right now, because it looks cheap relative to its own history, is different from buying it because the money flow says it's time. The money flow says rotate into infrastructure plays first, come back to the hedges later. If that thesis holds, Bitcoin could correct further before the setup actually becomes attractive on a risk-reward basis. And that's precisely the setup the liquidation map is currently pricing in. So, where does all this land? Bitcoin structurally is weak. It's below 60,000. Long-term holders are holding record amounts, but at compressed valuations. Spot ETF outflows are real. Leverage is being cleaned, which is actually healthy, but fresh longs are returning to the market, which typically precedes another wick lower that flushes them out. The Japanese yen is at levels not seen in 4 decades, which could trigger sudden BOJ intervention and ripple through global equities. Semiconductors are up massive amounts on AI hype, and at some point that's going to cool. Regulators in America might finally get clarity legislation across the finish line before summer, or they might fumble and watch it die on the vine for months. And Europe is making itself inhospitable to the major platforms, which signals that resistance to regulatory overreach is futile there. That's a lot of moving parts, all of them potentially volatile, none of them pointing cleanly upward. But that's precisely why this old coin trader doesn't panic. Discomfort and volatility are where margins live. Capitulation is when long-term holders hit losses and panic sell into the void. We're not there. We're in the space where pain has arrived, but the real fear hasn't. That's uncomfortable. That's not yet catastrophic. And catastrophic is where the reversals usually start. The convergence of these forces, currency weakness, sectoral rotation, regulatory fork in the road, leverage cleanup, creates a genuinely high-stakes moment, not because Bitcoin is about to go to zero or hit new all-time highs, but because the market is at a junction where structural forces are about to test the resolve of every participant. When the yen finally triggers a BOJ panic response, or when semiconductor valuations finally correct 30 or 40% from these nosebleed levels, or when clarity legislation either passes or dies, or when fresh liquidations cascade through a market that everyone assumed was already clean, that's when we find out what was real and what was hope. Bitcoin's role in that conversation is no longer as the lead actor. It's as part of a much larger ensemble cast. It's competing for capital against AI infrastructure plays and traditional hedges against currency devaluation. The question isn't whether Bitcoin is broken. The question is whether the macro backdrop swings back in its favor before it breaks further. And that's a question that doesn't get answered in the next few days. It gets answered over the next few weeks and months, especially once Congress picks back up in the fall and the yen stabilizes or snaps. Until then, we're in that uncomfortable zone where weakness is justified but capitulation hasn't arrived. For a portfolio manager or a trader, that's the difference between a tactical short and a strategic rebuild. For a holder, it's the difference between averaging down with confidence and averaging down hoping the pain stops soon. Very different beasts. That's the story beneath the headlines, the machinery running behind the price action. If you're serious about understanding where capital is flowing and why, you can't afford to miss the macro backdrop. It's the river, and price is just the leaf floating on it. Subscribe to Finance Graph for the deeper read on markets that are far more complicated than the headlines pretend, and come back next week when we dissect what happens if that July regulatory deadline actually slips. Until then, keep a close eye on Tokyo. This video is educational commentary on market mechanics and public information. It is not financial advice, and you should consult a qualified advisor before making any investment decisions.